Welcome back to our channel, where we break down complex financial concepts into simple, easy to understand explanations. Today, we're diving into the world of finance to learn about futures trading. So grab your markers, because we're going to illustrate the ins and outs of this fascinating topic. Let's start by answering the question, what exactly is futures trading? At its core, futures trading involves agreements known as futures contracts. Think of these contracts as a handshake deal between two parties, a buyer and a seller. A futures contract outlines the details of a trade. It specifies the type of asset being traded. It could be commodities like wheat or gold, financial instruments like stock indexes, or even currencies. The contract also states the quantity of the asset, the price at which it will be bought or sold, called the futures price, and the date when this transaction will take place, known as the expiration date. Now, here's where it gets interesting. These futures contracts aren't just private deals. They're traded on organized marketplaces called exchanges. Traders like you and me can buy or sell these contracts. If you believe the price of the asset will rise, you go long and buy the contract. If you anticipate a price drop, you go short and sell the contract. But wait, there's more to it. To participate in futures trading, you need to put down a deposit called margin. This is a small percentage of the contract's value that ensures you can cover potential losses. As the market fluctuates, so does the value of the contract. This daily adjustment is known as mark-to-market. Profits and losses are settled daily based on the contract's current value. Now, when the expiration date arrives, it's time for settlement. This can happen in two ways, either through cash settlement or physical delivery. In cash settlement, the difference between the contract price and the market price is settled in cash. Physical delivery, on the other hand, involves actually exchanging the underlying asset. Why do people engage in futures trading? Well, there are two main reasons: speculation and hedging. Speculators aim to profit from price movements, while hedgers use futures contracts to protect against price changes. For instance, a farmer might lock in a future price for crops to avoid losses due to price drops. One last thing to remember: futures trading offers leverage. This means you can control a larger position with a smaller upfront investment. But remember, with greater potential for profit comes greater risk. So, there you have it, a crash course on futures trading. Remember, it's a powerful tool that can help manage risk and seize opportunities. But it's crucial to understand the mechanics and potential risks before jumping in. Thanks for joining us today. If you enjoyed this explanation, don't forget to like, share, and subscribe. Until next time, happy trading.